in markets, the clouds seem to be parting a little bit as far as Hong Kong and Greater China equities are concerned. What are the risks 30% into a rally we need to be thinking about at this point?
I think the rally can really be sparked from two things, right? One is the valuations. If you recall, right before Lunar New Year, we went to a level where we're hitting new lows from last year. And I think we had a pretty strong series of policy support from the Chinese authorities. And we also saw concrete market support in terms of the national team buying the ETFs. We see this data. And I think that sparked the rally post-Lunar New Year. And post that, we have also seen pretty good macro data coming in. First quarter GDP obviously better than expected. Yeah. Some nitpicking over the consumption number for March, but overall the macro situation seems to have stabilized in China. I think that led to a lot of global investors, which has been very underweight China for most of last year and entering this year, to perhaps reduce a little bit of the underweight. Yeah. We are up about 30%, as you mentioned, on Hang Seng Tech. But if you look at the valuations, you're probably still not stretched for some of these names that's still going to be structural winners within the overall e-commerce and internet space, I would say. Yeah.
How do you look at flows? Because, we talked about the dollar peg. Maybe that is a way for people to kind of seek shelter amidst this volatility around Fed repricing and the like. Are you seeing a lot of that rotation come through from markets like Japan, markets like Taiwan, coming back into the mainland market?
I think there's probably some of that from the Japan rotation because there has been a one-way trade for some time now. I think for the other countries, it's less obvious to me because for North Asian economies, typically the currencies are not that volatile relative to the USD. So the relative changes of a few percentage points probably doesn't spark that trade. But that's probably more from a macro trader point of view rather than for equities, I would say. Yeah.
So for someone that overlooks overseas funds like yourself, right? So EMX China has done very well. Being underweight China, you've paid, you've been rewarded to stay underweight. Do we need to rethink that now?
I think to
protect your alpha?
Yep. I think to a certain extent you need to. I think a lot of the underweight that was taken was because people were no longer sure about the outlook. And if you really grind down to it, it's more or less a confidence issue, right? Be it from the consumer perspective, be it from the corporate perspective. And people just wanted to see what else the authorities could do to support confidence. And I think the latest round of policy support that we've seen earlier this week seems to suggest that more is on the way. And I think that's kind of anchored people's expectation and prevent a further vicious cycle downwards. And that's definitely been helpful. And if you look at the rotation so far this year, very clearly Hong Kong has been a clear winner in that particular race from the rotation from EM, ex-Asia economies outperforming last year and then outperforming this year. So overall EM has outperformed Asia ex-Japan on a year-to-date basis.